The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our first broadcast of Rancho Santa Fe Market Talk. We have designed this broadcast and it's live, so please bear with me just a little bit, in order to bring a monthly update as to what's going on in our local Rancho Santa Fe real estate market. It's a great market. It's a market that's been in transition since probably the middle of 2007. And it's a market that once we understand it as buyers, sellers, and as realtors, it becomes quite easy for us to navigate through it. So what I'm hoping to do today is kind of give you a little historical background about how the market has performed, and also to provide some insight as to how I think the market's going to perform in the future and why. So what I'm going to do now is I'm going to bring up a PowerPoint presentation. I've got some charts. We're going to go over each one of them, and we're going to take a look at how the market, like I said, has performed. We're going to look at some specific communities. We're also going to look at a market share report so that you can see what real estate companies are actually doing business in Rancho Santa Fe and to what degree they have been doing business. So I really appreciate you being here. I look forward to this webinar. It's brand new to me. I know I'm going to make some mistakes. I would love to have you ask questions. Maybe you'll type a speak and voice. I think we're going to do sort of our PowerPoint presentation. So again, just bear with me just a second. As you can see here, we are the Rancho Santa Fe Market Talk. I am Michael Taylor, the Michael Taylor Group of Prudential California Realty, and I'm looking forward very much to this discussion. I think before we move into all the positive news, I kind of want to answer the questions that everybody asks. What about foreclosures? What about bank-owned properties? You know, is it really as bad as the newspaper says it is? Is it really as bad as reported on CNBC every other day? The answer, quite frankly, is no. It's not that bad. But what I want to do first is let's take a look at the foreclosures in Rancho Santa Fe and the bank-owned properties here in Rancho Santa Fe. As of today, there is reported 6 bank-owned properties by ForeclosureRadar.com. ForeclosureRadar.com is probably one of the best national sites that gives all the foreclosure information that exists by zip code and community all across the country. For the most part, I would say they're about 94% accurate, something like that. But it does give us a really good indication about what's going on. Again, there are 6 properties that were reported as of today by ForeclosureRadar.com that are actually owned by banks. You have 2 of them, 3 of them are in the Covenant, on El Vuelo, on Villa Raposo, on Los Moros, and then 1 of them is in Fairbanks on Calle del Alcazar. And then we also have 2 in the Bridges, both of them contiguous parcels, 1 an empty parcel, 1 a home on Villa Candela. As we get into the active foreclosures, there's actually 40 properties that have a notice of default filed and or have been also scheduled for a foreclosure sale at auction. So between the 2 of them, that's 46 properties. And I have to tell you, again, that number bears no relationship to all the bad news that we continue to hear in the newspapers and on CNBC and things like that. It's very interesting with the high end, and again, I've been around this for about 32 years, 19 years in the banking business and almost 14 years here on the real estate sales side of that formula. But in the high-end communities, it doesn't tend to fall as rapidly, and it doesn't tend to hit a bottom as quickly, and it doesn't tend to have as many problems in terms of sheer numbers that we have in other over-leveraged communities such as Oceanside and Chula Vista and places like that, where an awful lot of people were buying properties that, quite candidly, they could not afford. So anyway, so that's the bad news. We have 40 properties in foreclosure. We have 6 bank-owned properties. And we have a market that actually was more active in 2010 than it was in 2009. And here I want to kind of show you exactly what I mean by that. This is a chart, and what this is this is the number of multiple listing sales that were reported in each of the years going back to 2002 by price point. And where this becomes really relevant is to look at the trends both in pricing, in terms of absorption, and just in terms of historical market performance, so we can keep everything in perspective and keep our expectations sort of aligned with the market, whether we're a seller, a buyer, or a real estate agent. If we look back at 2002 right here, there were 309 sales, MLS reported sales, in Rancho Santa Fe. And that's every community of Rancho Santa Fe. That's the Covenant, that's Fairbanks, Del Mar Country Club, the Farms, it's Whispering Palms. It's every community within Rancho Santa Fe, zip codes 92067 and 92091. And as we look at from 2002 right here, and as we skip over to 2004, 2004 was our peak year with the most number of reported MLS sales in the history of our community at 352. That was the year when actually prices had not yet hit their peak, but the absorption rate was very high. From 2004 all the way through 2009, the number of sales that occurred every year went down. And people say, gee, why did that happen? Well, I can tell you that there's 2 primary reasons that that occurred in Rancho Santa Fe. The first reason is like any other thing that sells, the prices continued to go up all the way through early of 2007. As the prices go up in any kind of product, you typically have sales drop off. And that's what happened here. As the prices went up, the number of buyers willing to pay those prices continued to drop off until it hit an all-time low in 2009. But the other interesting thing that happened to us here in Rancho Santa Fe is between about 2002, 3, 4, 5, 6, 7, we actually had adjoining communities that prior to this period of time had not existed. And those communities were the Bridges, who really started its big sales push back in 2002, late 2001 through 2002. We had the Crosby, which came online at about that same time. We had Santa Luz, that has over 804 home sites within its gates, also come online. And during this period of time, we also had Rancho Pacifica. Rancho Pacifica brought online 149 sites. Many people actually sold their Rancho Santa Fe properties, bought a site, and built their home. Many of our spec builders who were very active from about 201 through about 206 also were buying a lot of lots within these communities, building new product. So 2 things occurred in Rancho Santa Fe that really diminished our sales acceleration or our sales numbers. Prices were going up, and product became available, new product became available at similar pricing in adjacent communities. We see as we look at the chart that in 2009 we hit an all-time low with only 148 transactions in every community in Rancho Santa Fe. This was the time when we realtors, if we weren't saying the sky was falling, we were certainly feeling it. But it was also the time that those of us who looked at these numbers realized was going to be our bottom year in terms of transactions. That from that point of 2009, we only had good news to follow, and that was that the number of transactions would go up. And in fact, the number of transactions in Rancho Santa Fe accelerated 45% between 2009 and 2010. Now, I think one of the most important ways to look at this is to look at it by price point. Because, and let me just take, let's just take the example of $7 to $8 million right here. In 2002, there was one sale within that price point in Rancho Santa Fe. None in 03, 3 in 04, 3 in 05, 4 in 06, 3 in 07, 2 in 08, 2 in 09, and guess what, guys? This year, so far, we've had 2. And we have 2 more in escrow. So what we actually are starting to see now is that we're starting to see a slight acceleration in the sale of these high-end properties. And if we look at the historical numbers, even through the good times, what we see here is, for example, over 7 million in 2006. There were 7, or 4, 3 is 7, 9. There were 14 sales above $7 million in 2006. How does that compare to 2009? There were 3. 14 down to 3. Unbelievable. However, this last year in 2010, that 3 became 4. Okay? And so far this year, that 3 is already at 2. And we have one other property within that same price point in escrow right now. Now, in order to really determine how long and what you have to do to sell a home in any of these price points, probably the most important comparison is to compare the number of units, the active units that are on the market today, to the number of sales within those price points that occurred last year. And here's a prime example. Under $1 million in Rancho Santa Fe, and this also includes the Morgan Run, Whispering Palms area, we had 33 sales. Well, we've already had 8 this year. We already have 8 in escrow, but we only have 17 properties listed right now, listed for sale that are within this price point. That's about a 6-month supply of inventory. What that means in terms of these ratios between supply and demand is that this is a balanced market. The chances are we will not see the prices go down any further within this price point because we do not have enough inventory and few buyers to drive those prices down any longer. So let's call this a stabilizing price point right here. Let's move to the next one in the $1 to $2 million $1 to $2 million price point. Look, this was the most amazing thing. In 2009, there were only 43 sales within that price point. Look at this phenomenal jump that took place in 2010. It was a tremendous time to buy a property and to sell a property because buyers were coming out of the woodwork. And already in 2011, in the first 3 months, we've closed 22 sales in Rancho Santa Fe and have 17 pending within this price point. So what does that mean? That means that this price point too is starting to stabilize. We currently have 59 active listings. We have 17 in escrow. We have 22 that actually have sold so far this year, and that's only an 8-month supply. Again, a really, really good number. Now let's move up to the $2 to $3 million price point. And here, and I'm going to be a little more brief, but here we had 52 sales last year. We've had 16 this year. We've had 12 in escrow right now, but we have 66 active listings. Based on last year's absorption rate, we have a 15-month supply within this price point. That means that if you're a seller within this price point right here, you have to win the beauty contest, meaning that you have to be the best product in the best shape at the best price, because there aren't enough buyers for every seller that exists in the market today. So it's a more highly competitive environment. As we move down to the $3 to $4 million price point, now we run into a real supply issue where we have 25 current listings. We had, we had 46 current listings, and we had 22 sales last year. That's a 25-month supply of inventory. The only way that anybody can ever predict that pricing is going to go up is when you see these active listing inventory numbers dip significantly below the historical absorption rates that you see right here. because that means there would be more buyers than there are sellers. When there's more buyers than we are sellers, we have a market that starts to get bid up. And that's exactly what occurred back in this time frame right here. During this time frame where we had a lot more buyers than we have today, and we had a lot fewer sellers than we had today, it was a great formula to drive those prices up. Now everybody can talk about loose money, and they can talk about, underwriting standards that were abandoned, so if you fog a mirror, you got a loan. All of those factors, what they do is they impact demand. If more people can borrow more money and they feel really good about the market, there'll be more demand to buy a house. If there's more demand to buy a house and there isn't enough sellers, the prices get bid up. Let's look at what we think is going to happen this year from these numbers right here. If we look at the number of closings that have occurred so far this year, excuse me while I find my cursor here, we had 56 closings so far. And of those 56, and if you take, and that's through March 31st, that's the first 3 months of the year. If you take that times 4, that's 224 sales. Now, it will be more than that, in my opinion and my prediction, because we're, again, dealing with the first quarter of this year. As long as interest rates remain relatively stable, as long as the world geopolitical landscape doesn't get too far out of hand, and as long as we don't have any more economic crisis that we don't know about, I would say that we're probably going to end up with somewhere around 235, 250 sales this coming year. That's, again, really good news for a lot of sellers. You're going to still see within this time frame, because of these levels of supply, you're actually going to see some downward pricing pressure where you've got 2, 3, 4, 5 year supply of inventory. In order to win that beauty contest, there will be sellers who will find the market with their pricing. The buyer will have gotten and feel they've gotten a very good deal, and there will be transactions. Another little thing to kind of note, and this is kind of another little thing to look at historically, and I view it as the over $3 million performance of the market. And what you see here, really starting in 2004, is you had a big rise in the number of sales that were over $3 million from its previous performance levels. It almost doubled from the 202, 203. And then it hit its peak on the over $3 million market in 205. And then from that point, it continued to go down, where it hit, again, an all-time low of basically only 1/3 of the number of sales it had in 205, over $3 million. And then last year in 2010, it came up to 46, which is a really nice number. And here we have 10. Okay, so if you take 10 times 4, because we've done the first 3 months, that would be 40. Again, I think we're going to end up somewhere around 50-ish sales, maybe 52, 53, hopefully 55 sales, over $3 million this year. Where it gets really interesting is to look at this inventory level here, because you still have, if you have almost a 4-to-1 ratio between under and over $3 million sales, your inventory ratio is about 1.2 to 1. It's not 4 to 1. So we have a significant amount of inventory, over $3 million. It's a 30-month supply in the aggregate based on last year's absorption, which was higher than the previous year of 2009. So once again, as we look at this, it's very, very predictable that we're still going to have some downward pressure on pricing. But I have to tell you, what's happening in our market is that it is moving, I don't want to say rapidly, but I'll use the word steadily towards stabilization. Because as we eat up these inventory levels, it will stabilize pricing, and then everybody's going to feel a little bit better about where they're at in the marketplace. I have done the same chart, and this is for the covenant. So those covenant owners who are watching, this is the exact same analysis for the homes in the covenant. Again, we hit an all-time low in the covenant of 46 sales in 2009. We hit an all-time high since 2002 in the covenant, again in 2004. And then we jumped up a really nice number to 70 MLS reported sales in 2010. And where we really saw a big change in 2010 was right here. If you look in this price point of $5 to $6 million, we hit a peak of 6 sales in 2007 from its other high a peak in 2004, down, slightly up in 2007. Then it remained fairly constant from 2008 to 2009, and then we had a nice little plunge upward in 2010. So again, what we're dealing with here is we're dealing with a really, really nice increase in people willing to buy properties over $5 million compared to what it was in 2009. Now, these are the actual raw numbers. For example, and I'll just give you this example right here. Right now, there are 7 properties on the market between $5 and $6 million in the covenant. It's just barely over a year's supply of inventory. This is really, really good news. Now, when you get into the $4 to $5 million price range, this is where it gets kind of interesting again, because in 2009 we had 4 sales, in 2010 we had 6. We've had 3 so far. We have 16 properties on the market right now. So if you compare that 16 to that 6, that's a 2.76-year supply of inventory. However, if we look at what's occurred the first quarter with 3 closings and 1 pending sale, I can tell you right now that that the number of sales between 4 and 5 million in the covenant is going to accelerate again this year. I would predict, based on what we see right here, that we're going to end up with somewhere between 82, 83 to 90 sales in the covenant. That's my speculation. Again, I think there's not going to be a lot of upward pressure on pricing unless it occurs somewhere under the $2 million price point, because that's where we lack inventory and we have plenty of buyers. So anyway, as I get down here, sorry. This is the same thing for Fairbanks Ranch. And again, I feel like I'm kind of beating a dead horse. But again, their numbers are very similar to the covenants and very similar to the Rancho Santa Fe as a whole. Fairbanks hit its peak up here in 2004. It came all the way down to only 24 transactions in 2009. Had a phenomenal leap up to 43 transactions in 2010. But here's where it gets really interesting in Fairbanks. I mean, if you study the trends, is that 18 of our 43 transactions in 2010 were under $2 million. That's all the way back to 2003, where there were 15. And then as the market pricing continued to go up, the stuff that did sell for under 2 started to sell for over 2, and the stuff that sold for between 2 and 3 started to sell between 3 and 4. And so you see a movement, a historical movement of pricing that's occurred back in 2010, back downward in terms of pricing, which brought 32 of the 43 sales under $3 million. And that compares to only 19 of them that were under $3 million into, for example, 2006, 38 in 2004. So anyway, so as the pricing has come down, again, we have higher absorption rates, and with those higher absorption rates, we're burning off some inventory. Fairbanks as a whole, if you can price points, has only about a 0.84 years of inventory, and that's it. So that's a good number. Some of the higher price points again have a higher level of inventory. Their burn off time is going to be longer. Again, we look at the under over 3, and starting in 2009, it was about 3 to 1. 3 of the sales under 3, 1 of the sales over 3. That held consistently from 2009 to 2010. We're down to 2 to 1 so far this year. If you look at all the stuff that's pending right now in Fairbanks, it's all under 3. But we have had 2 sales that have occurred this year. Again, there will be a little bit of downward pressure on pricing here, but we are at a much lower inventory level than we were almost 2 years ago. This chart's a little hard to see, and I apologize for it. This is the Bridges sales, and the Bridges has 3 different product types, and I've kind of divided it up by those product types. But the first one's the villas, then the Cortillos, and then the custom home sites. I think some of probably the most important thing to look at here is that in 09, again, we hit a low of 8 sales in the Bridges. Last year, we jumped up to 16. Where some of the sales have actually occurred is that in 2010, we had 3 villa sales, and that's down from a high of 18 back in 2003. The villas came online in 2001. But so far this year, we've had 1. But we have 8 villas on the market right now. And so it is kind of a contest to see which of the villa's owners are going to capture the buyer. And again, a big part of capturing that buyer, unfortunately, is pricing. If you have a good product and it's well priced, you win that beauty contest, you're going to win. Where it gets kind of interesting again is right here in the custom home area. There are currently 16 homes that are on the market. We had 7 sales last year. So just based on those numbers alone, that's about a 2.3-year supply of inventory based on the absorption. Unfortunately, through the first quarter of this year, we've had no sales or closed escrows of custom homes. So this has been a little bit harder sale here recently, although I do think that it's going to improve quite significantly throughout the year. Again, it's a little harder to predict because the inventory levels are pretty high. The last thing, or not the last thing, but it's almost the last thing I want to share with you is just what's called a market share report. And this is kind of an interesting report because what this does is that everybody wonders what companies do business in Rancho Santa Fe. Who owns the market? You know, is it Prudential? Is it Willis Allen? Is it the various states? Is it Coldwell Banker? Is it Windermere, you know, one of the new companies on our landscape? And what I've done here is put together a market share report. And this is all of Rancho Santa Fe, but I did include the community of Santa Luz. And the reason I included the community of Santa Luz is because last year Santa Luz had 61 sales. The Covenant of Rancho Santa Fe, who has almost double the number of homes within its community, that actually more than double, than Santa Luz, had 70 sales. So here what you see is the total number of sales in the community that occurred last year, with the Covenant obviously being first at 70, Fairbanks second at 43. Although Santa Luz is not in the Covenant, it did have 61 transactions last year and sales. And what this does show is what companies represented the buyers and sellers. Well, this is kind of an interesting thing because what you see here is that Prudential California Realty, with whom I happen to be affiliated, actually represented 28.62% of all the sellers in all of Rancho Santa Fe and Santa Luz, and they represented 31.52% of all the buyers. That means if you are in Santa Luz or Rancho Santa Fe and you list your home, there is a 31.52% probability that a Prudential agent is going to sell it. It's really good. Then you get to Willis Allen here. They represented 14.49% of the sellers, 7.61% of the buyers. Coldwell Banker, 15.94% of the sellers, 13.41% of the buyers. And then you get to various states. States represented 7.9% of the sellers and 6.52% of the buyers. And then it drops off pretty significantly from there. This category called All Others is all the other small companies that people have never heard of, or they're one-offs or something like that. And because we have so many people who have gravitated towards our industry during the height of the market, we also have a tremendous number of people that have friends within our community. And as you can see there, all the others combined represented 23.91% of the sellers and 29.71% of the buyers. So again, this tells you who's actually doing business. It's been amazing to me, having spent 14 years in this industry, is how many people think one thing is true when the numbers actually bear something else. And so I've always made it a point in my career, whatever that may be, whether it be running a financial institution or now selling high-end real estate, is always look at the facts, make your judgments based on those facts, and you don't have anything to lose. I've included something else here in conclusion, and this is the Case-Shiller 100-year index for housing prices. And this goes back to 1890, which is the base year. And what Shiller was attempting to do is show the quality, or not the quality, but the rise in values of real estate over and declines of values of real estate over a very long period of time adjusted for inflation, so that one could see that over time real estate has in fact, even adjusted for inflation, has been an investment that has not certainly been stagnant, and in the cases since the 1950s has gone up from what it was after World War II. But just to take a look at it, the base year is right here. This is 1890, and from 1890 you actually had a rise in pricing. Of real pricing, adjusted again after discounting inflation, and then you started to have a decline in that pricing when more product came online. Right here, years 1900, 1920, 1910, 1920. Again, more product was coming online. There was more inventory, and as more inventory came online, it had a downward pressure on pricing. And then the stock market, the World War I hit. And then you had the stock market crash in the 1920s. And here they took quite a dip down between that stock market crash in the 20s and really the beginning, and here's the Great Depression right here, carried through the beginning of the Second World War. And then after the Second World War, going into the 50s, certainly when I was born, and many of us were born, we saw a rise back up, and then this has kind of been its pattern since the 1950s. Most of us at our age actually remember the boom of the 70s and the decline of the 80s, the boom of the late 80s, the late 80s to the early 90s, and then the decline through the 93, 94, 92 period through about 94, 95, 96. And then look at this, guys. This is what we've been living. This was the greatest escalation in any generational period of time or any decade in the history of housing prices going back 100 years. And what this shows is where the peak was, which is July of 2006. This is where it peaked, right here. And from that point, since July of 2006, it's continued to go down. And here, interestingly enough, was a little uptick. And this is what the prediction is in terms of where it settles out. So if you look at it, it looks like it's going to settle out about where the bottom settled out after the 1980s, early 90s recessionary period. So we just went up so far that we now have to come down to hit back into this trough area, and then we'll probably just kind of, limp along here, would be my guess, for a few years until we absorb that inventory. So as long as the interest rates stay low, we get that inventory absorbed, we're going to go back onto this particular, we're going to go back to a more stabilized environment. I would like to, hold on, I've got to end that, do that. I'm back, sorry. Anyway, I can't thank you enough for joining me for this first webinar. I know it may be a little overwhelming, but I really wanted to try to provide some clarity with the numbers in terms of what we've all been experiencing, because the worst thing in the world to do is to go through the kind of adjustment we have and not really understand it. The truth of the matter is that it's supply-demand related. Our supply-demand ratios have gotten out of hand. When they got out of hand, then there's downward pressure on pricing, and then you take capital out of the market, which means the lenders stop lending. The lenders stop giving money away. They're still lending. And by the way, if anybody thinks the lenders aren't trying to figure out more ways to make loans, you're wrong. They are. We see underwriting that actually the pendulum swing way too far in one direction is now starting to inch its way back to the middle. And I would predict within the next 12 to 18 months that we're going to have some pretty reliable standards that we're going to be able to see. Anyway, I want to thank you immensely for, hold on just a second here. I want to thank you for being here for this webinar. I apologize because I do not have, obviously, the greatest skills in this area, but I'm going to try to get better. I really, really do appreciate all of your attendance, and I really appreciate the fact that you would support me. I got significantly more people that registered than I ever could have imagined. If there's anything at all that I can do to help you at any time, please just give me a call. My office number is 858-756-5120, and my cell is 619-813-5950. This is Michael Taylor. I am signing off. It's going to be a good real estate year. Happy hunting, and let's all get back in this thing one thing at a time. Thank you. Bye-bye.